Hey everyone, it's August 6th, 2015. In this week's video, I'll touch base on a few sectors of the market and shed some light on the cash balance of the S&P 500 X financials and on the ratio between S&P 500 cash and market cap. Before I do so, I want to give you a quick rundown of our recent performance. As of today, we're up 38% in aggregate, or we're up 1.8% on average. If you compare this to the benchmark rate, whether it be the S&P 500 or even the Nasdaq 100, over the same time period, we're generating returns in excess of those yields. If you compare it to the risk-free rate, whether it be a 1 month or a 3 month T-bill, we're also generating returns in excess of those yields. So this is a great place for risk-oriented and risk-averse investors to join, not only to profit from the trades we recommend, but to really gain first-hand insights into how to read markets, what to look in foreign markets, and ultimately how to place trades. I also encourage you to visit the website at least once a week. That way you can read our most recent blog post, and you can also review our videos through our website. With that said, let's take a look at different sectors of the market. First, I want to give you a quick rundown of what the prominent theme is today, and that has been basically whenever a major sector, whether it be consumer discretionary, consumer staples, healthcare, whenever one of these sectors reaches a Fibonacci extension, it tends to spend some time trading in and out of these sectors. Since right now we're looking at a monthly picture of the consumer discretionary group, really we should expect the XLY to consolidate in the current range for at least a few more weeks, if not months. This is part of the reason why markets so far in 2015, especially the S&P 500 and the Russell, have been so rangeless. It's essentially because we've had such a big move from the 2009 low to the current high that people are trying to ascertain what may lie ahead. Whether that's good or bad, that's at everyone's discretion. But what I want to ultimately give you a heads up on is that once a Fibonacci extension is reached, it doesn't mean a support or resistance band, price band, has been met. Since the biggest component of Fibonacci extension is time, you cannot use these Fibonacci extensions as support and resistance points. I made this point very clear a few weeks back when I mentioned how time and not price was the biggest factor to a Fibonacci extension. So for that reason, Fibonacci extensions should be used more as pivot points than actual support and resistance points. Nevertheless, they should be a price point you take into consideration, whether you're looking to buy, within a few minutes, a few days, a few weeks, or even a few months. Whether you're looking to trade or invest is what I'm trying to say. So, as you can see here in the XLY, we tagged or came close to tagging the second Fibonacci extension, and ever since, or so far this month, we've pulled back. Even though the XLY has, can be seen as a leading sector so far in 2015, you shouldn't expect an imminent breakout anytime soon, simply because if you measure where we came from and where we are today, it's only reasonable to expect people to rotate in and out of sectors at this Fibonacci extension. So again, this will contribute even further to the rangeless market we have today. Could that potentially lead to a break higher? It could, and if we produce a new high in the S&P, it's going to be a shallow high, very similar to what we've seen all along, where again we consolidate 4 to 6 weeks, break out higher, and then establish a new high, and then consolidate again for a new period of time, usually between 4 to 6 weeks. If you look at another sector like consumer staples, it's the same story, where we tag the second Fib extension on the monthly, and look what's happening. Basically, people are selling the rips, selling any gap up, and buying measured dips. If you look at technology, it's a little bit different. In this case, we're basically in the middle between the first Fib extension and second Fib extension. Perhaps this is a main reason or one of the reasons why investors continue to flock into technology. It's because in the event that the market were to trade higher, there's still a good amount of room for tech to run. If and only if we account for fib extensions. If you take other factors into consideration, which you should, then that could change or it could support your viewpoint. But whatever the case may be, you could see that tech, in case there's further market strength, could potentially push higher. If not, then it's reasonable to expect it to trade back to the first fib extension. If you look at another leading sector like healthcare, it's the same story. We tagged the third fib extension to the 1 month range, and you can see that people have begun to take profits. What I worry most about the market short term is the fact that in some of the leading sectors, most notably healthcare and biotechnology, we set long-legged tails on the monthly and the weekly. I mean, if this were a bullish market where new highs were imminent, you wouldn't see this type of behavior. It reiterates the point we've seen, or the point I made all along, where essentially people buy the measured dips on winning sectors, and they sell the gap ups or extensions on stocks within the healthcare group or biotechnology group. If you look at the IBB, it's the same story. Even though this, one could argue, is technically further stretched. You could see here that the IBB tagged or came close to tagging the first fib extension from the most recent high. Whether that leads to a wider sector imbalance and market breakdown, again, remains to be seen. But these are all price points you have to take into consideration, even if you're a day trader. If you don't have these points in mind, when and if a breakdown or breakout takes place, you're going to be clueless as to what is really taking what is really taking shape. So just be mindful of that. So right now, biotechnology, healthcare, consumer staples and even technology are some of the leading sectors today. But even so, it's not really giving us a clear enough signal that markets are ready to push higher. With the same token, they're not really leading us to believe a wider sector breakdown is imminent. If you look at a interest rate sensitive sectors such as industrials, notice how, as opposed to a leading sector like healthcare and consumer staples, it's actually using the first fib extension as a level where people rotate into, not out of, the XLI. So this is precisely what I was trying to mention from the onset. Fib extensions are not support and resistance points, number one, and number two, they're being used today as levels to scale in and out of. So just for that reason, you can't really base a mid-term thesis on this market and say, all right, markets are ready to push higher based on the technicals or what the charts are saying. I mean, obviously you can come to much clearer and much more focused conclusions based on other factors, but just from the technicals themselves, they're not really giving you much of an edge. And that's problematic because more than half of this market relies namely on technicals. So lastly, let's take a look at the S&P 500. The S&P 500, and even the Russell 2000 are all trading above the midway point to this year's bullish engulfing. Notice how even though price seems seemingly weak at this upper range, it's still trading above the 50 or the midway point to this year's range. Same holds for the Russell 2000 and most certainly for the Nasdaq. The Dow Jones Industrial Average, because it's more levered to the economy or to the changes in the economy, it's acting a little bit weaker. But you can't really be overly bearish or overly bullish today. So again, I hate to be so indifferent, but that's what the market is really giving us. It's not really giving us much to chew on. Of course, in the daily newsletters I send, I'm much more precise. I give you further tools to chew on and further tools to really consider and really open your eye as to what to focus on. The monthly reports is really a place where I share with you the indicators worth tracking, what they mean, given the current circumstances, and hopefully it should give you again a better sense of what to look for and how to trade markets. Lastly, I want to talk about the cash of the S&P 500 X financials and the ratio between cash and market cap. The cash in the S&P 500 X financials is at an all-time high. FactSet, which sends out a report every month, show that in the month of March, or excuse me, in the fourth quarter, which ended in January, marked the highest cash balance for the index X financials at 1.43 trillion. Again, this is the highest it's been ever. One of two things could happen here. Either, but before I do so, before I delve into the cash to market cap ratio, I want to give you a quick rundown. FactSet, the investment report is sent out every month, which I should mention is free. If you're interested enough and you really want this, to read this report for free, it's usually a few months late, but that doesn't really matter. I mean, as long as you don't want to pay for it, and you should find it online for free. So, information like this, where it shows you aggregate cash, capital expenditures, net shareholder distributions, and then they subdivide them into different sectors, show you how, essentially investors at the institutional level and retail level are perceiving markets based on how they're allocating their portfolios, is really the type of information you want to focus on. All the other stuff that's thrown around, not just on social media but on TV regularly, is not going to help you whatsoever in really understanding what the markets are and how you should trade them. So I'm not going to go into detail as to what this report specifically says. If you're interested, I'm going to include the link at the bottom end of the video. That way you have you have the link to it. But ultimately, what I drew my attention here is two factors. Cash balances for the leading sectors this year, which have been consumer staples, healthcare, and biotechnology, increased the most on a quarter or on a sequential basis than any other sector. That is perhaps, or explains in part, the reason why investors are so bullish, healthcare, biotechnology, and tech. It's essentially, and even consumer staples. It's because these companies have been able to amass the biggest cash balance over the last quarter than any other sector. As as plain as it seems, rising cash balances typically is not very positive for the economy overall. It doesn't really lead us to believe economic growth is present. All it means is companies are, just as in consumers, are very risk adverse, and they do not know what will happen with the economy next. For that purpose, they're not willing to invest much in capital. And if you actually look at the report, it says that the firm, FactSet, expects capital expenditures to decline 3.4% year over year after having grown 6% year over year. So that shows you investment in actual capital, physical capital, depreciating capital, right? Firms are not actually going out and buying new stuff because, first, they're laying off people, and they're not expecting demand. Obviously, you have to subdivide demand and see how it functions within the aggregate demand picture that we're referring to. But the point is that if firms are hoarding cash, that means there's a lot of instability in the economy. That's a given. It also means there's not much clarity as to what business may look like in the future, and as default, it obviously means that demand cannot be accurately forecasted, even by firms, right? People that do the business, that do the transaction, that even fund part of the business, they don't even know what business is going to look like. So economically, it's not a very good sign. But if you look at the stock market, notice this discrepancy and even correlation between cash and cash to the market cap ratio. The rising current divergence can be explained one of three ways. Either cash increased and remained flat at the expense of a shrinking market cap increased at the expense of a shrinking or flat cash level, right? or it's a mix and match of both. Obviously, it's evident that it's the latter, or option number three, where it's a mix and match of both. Where essentially, even though cash levels have risen, market caps have also risen because essentially investors are willing to assign a higher value, whether that's whether that merits the higher market cap value is another question in itself. But essentially, investors are willing to assign a higher market cap, right, a higher value to all these companies who have been able to generate excess cash because they see cash essentially or currency as the best investment today. So what can we expect going forward? I mean, if you look at the quarters or the earnings transcripts I've read, most companies, even if they report lousy quarters, they've been buying stock or issuing new stock buybacks north of 500 million, even some as high as $2 billion over a 1 to 2 year time horizon. Just recently, Baidu came out with a lousy quarter, but it issued a few days later a $1 billion stock buyback. Same with Keurig Green Mountain Coffee Roasters. Noodles and Company a few months back reported $400 million stock buyback for a company that essentially not many people are giving credence to or the benefit of the doubt. So the long story short is, as long as cash levels remain high at the corporate level and risk, in part measured as corporate debt, remains fairly low, stocks shouldn't be avoided. They should be looked into as a possibility. Does that mean the market cannot correct? It most certainly can, and most certainly will. But on a longer term time horizon, you're looking 2 to 5 years out, stocks are ultimately the asset class most investors choose. So just be mindful of that when you're trying to place different trades, irrespective of your time frame. And again, I welcome you to read these reports, because this is really where most of the good information, unbiased information, really at. So with that said, I want to thank you for taking the time to watch the video, and I wish you good luck in trading.